Good morning, everybody, and happy Friday. It's the 25th of February. I'm Joe Neighbour from Signal Centre talking ball this morning. Just myself. Steve's off for the next couple of days, making the most of his birthday. So wishing him a lovely weekend. He'll be back next week. In the meantime, all go on the financial markets, as I'm sure anybody watching this will be aware. It was a pretty spectacular day yesterday. Obviously, dented quite severely as a result of the action being taken by Russia in Ukraine, which has spooked the markets quite considerably. But there was also a pretty substantial rally that took place after the sort of initial selling took place. Clearly, the Ukraine developments are dominating the headlines. The Russian attack on the country gathered pace on multiple fronts. There were missile attacks on Kiev, while Russian forces took control of the Chernobyl nuclear complex. There was also heavy and sustained cyber attacks on Ukraine from Russia. Western countries condemned the action and imposed further economic sanctions on Russia, including asset freezes on banks. There were no actions to block exports from Russia at this stage, which isn't a massive surprise. Obviously, one of their key exports is gas, which obviously we need. Huge swings in risk appetite yesterday after a measured initial response. Risk appetite eroded sharply on Thursday as risk aversion dominated and fears increased sharply. There was strong demand for defensive assets early on as equity markets come under heavy selling pressure. The yen and the Swiss franc gained strong support while the euro, sterling and commodity currencies all retreated very sharply. The dollar index surged to a 20-month high on defensive demand and also euro losses. In terms of what's going on in the energy prices, as we mentioned, European gas prices spiked over 50% higher in Europe on Thursday. On the oil market, Brent surged to fresh 7-year highs, hitting highs around about $102 per barrel, with West Texas Instrument also posting 7-year highs near $98 per barrel. There was also a sharp reversal in those energy prices later in the day, with Brent dipping back below $100 per barrel and the gas prices also retreating sharply from the highs amid the more measured tone. There is a little bit of chat coming out of the Fed, talking obviously about this case for raising interest rates. Similar situation with the Bank of England as well. Comments continue to dampen expectations that the Bank of England would decide on an aggressive 0.5% rate hike at the March policy meeting. So very much all go. Let's get stuck into some charts and have a look at what's happening. Just get the chart added to the screen. I'm going to start off with FX and look at the dollar index. So really big move to the upside yesterday. As I mentioned earlier, 20-month highs on the dollar index. So we can see this huge red candle here. I'll get rid of this box. This is sort of the level that I was talking about yesterday where I feel would be resistance. And that actually worked out pretty nicely. This is a 61.8% fib level, which we have to go back some time to see why it's relevant at 97.72. Let's just scroll back. So we're going from these highs that we posted at the height of the pandemic down to these lows that we posted in early 2021. As you can see, we've got that nice red line there, which is also the measured move of one of these double bottom patterns that completed on the dollar index back here in September 21. So it was always going to be a strong level, and it pretty much nailed it to the tick, which is, as a technical analyst, something that we always like to see when these levels work in such spectacular fashion. So that would have been a fantastic area to sell the dollar index yesterday, but it would have obviously required you to be quite brave given how strong the move to the upside was yesterday. It would have felt like standing in front of a freight train, but it worked very nicely. Overall, we still remain really bullish on the dollar index. It's still trading in this bullish channel, so therefore further upside is expected. We're up by 0.1% as things stand today. So on the flip side, Euro US dollar, big move to the downside, made a new low, took out the low that we posted on the 28th of January, didn't manage to sustain that on a closing basis, so we did rally quite sharply. We are off today by 0.15%. Overall, the trend remains bearish. We've got a measured move target of this head and shoulders top pattern here that formed over many months and broke in August last year. We're getting ever closer to that at 110.58. So overall still looks pretty bearish, still expecting to see lower prices. Sterling got hammered as well yesterday, continuing to trade lower in line with this downtrend. Huge move lower, as you can see yesterday. But again, the Fibonacci levels came to the rescue. This blue line here, the 78.6% Fib line of this move here from the lows in December to the corrective highs that we posted in January. Slammed right into that level and pretty much to the tick did a fantastic job. I've been saying for a while that the Fibonacci levels on cable have been really well respected. So pretty good strategy to use if you are looking to trade cable at the moment. Keep an eye out for those big fib levels. They seem to be doing a pretty nice job. Euro sterling, there was some decent upside move yesterday, seemingly finding some support around 83.07. Which is done on a few occasions now, closed higher on the session, engulfing all of the previous day's gains and looking like it's on the front foot in the very short term. But overall, as we know, the trend remains pretty bearish, so there's no sign of things changing on that front just yet. Taking a look at Aussie US dollar, swift reversal on that, breaking through the short-term uptrend that had formed the corrective uptrend, trying to get back above it this morning. I mean, arguably, we closed back inside that or very close to it, so not really too sure what to make of that at the moment, but expecting these risk currencies to remain pretty fragile. If we take a look at some of the other dollar markets, we can see yesterday was a strong move higher from the dollar versus the Japanese yen, although we did see the Japanese yen initially perform quite well as a safe haven, but it seems as though money flooded back into the dollar later on in the session, and that strength remained. A few other markets to skip through, so I'm not going to spend too long on these. We will do more of a comprehensive overview next week. Let's just take a quick look now at cryptocurrencies, specifically Bitcoin. My charts are a little bit messy because Steve's been mainly covering this of late, but we do have a 50% Fibonacci support level around about 36,430, which has done a decent job over a couple of occasions. Yes, we've overshot it a little bit, but we still seem to be hanging in and around this level. Swift reversal yesterday. We posted lows down as low as around about 34,300 before recovering quite substantially to post green on the session. Pretty flat as things stand at the moment on that. So let's move on to the commodities, starting with oil. As we mentioned, we hit fresh 7-year highs. Huge move yesterday, big move to the upside, but pretty much reversed all of that. And that is a pretty significant reversal candle. So we've got to go some way back, as we know, 7-year highs on oil. But that is a pretty spectacular reversal. We are on the front foot. We've actually gapped higher again today. Obviously, the situation with Ukraine and Russia isn't going away, so we can expect there to be more volatility in this market, and that is particularly highlighted by this huge candle that we saw yesterday. Overall, the trend remains bullish, and of course, we are going to expect prices to remain under pressure on the upside because of what we're seeing with the conflict in Russia. Looking at gold, that had a big move as well. Lots of money moving into that market as a result of fears about what's going on. But again, it pretty much closed lower on the session, having made highs up to 1973, highest levels that we've seen in a very long time for gold, going back here actually, which is September 2020. So overall, I'd say it looks pretty bullish. I mean, if we look at things on a weekly chart, that would indicate that yes, although it's sort of closing where it opened the week, it's been a very big range, but we are starting to see some evidence of fresh money moving into gold. So that looks quite positive for gold. Natural gas, let's just take a quick look at that. Obviously, on the intraday markets yesterday, we saw some pretty significant moves on the price of gas. Yesterday, we saw natural gas rally into some resistance at 4.76, and it posted, again, a pretty strong reversal candle. As you can see there, we posted highs up to these kind of levels, 4.936, only to close lower on the session and post quite a large shooting star candle. And backing that up with further losses today. So again, expecting more volatility in these markets. Let's take a look at the indices then. The FTSE 100 yesterday, big move to the downside, took out this level here from the 24th of January at 7227. but swiftly recovered to close back within this kind of uptrend or wedge that seems to be forming on the longer term charts and above this horizontal support. So for now, still looks pretty good. It is outperforming the rest of the markets at the moment due to that influence that it has from oil companies in particular. And banks are rallying as well today, which is helping. If we take a look at the DAX, as we know and as we've talked about, as Steve has gone through, it's broken down through this kind of top pattern through support at 14,809. Looks set to be heading towards our targets down here, the 38.2% fib level at 13,117. Things are going to be volatile. We closed well off of the worst levels of the session today, which got down to 13,800. We are on the back foot again today. Obviously, more ongoings in Russia and Ukraine overnight. Looking at the US markets, it was a significant turnaround yesterday on the Nasdaq. So we've got this, crude drawing of a head and shoulders top on this chart at the moment. We did close below it on the 23rd, but we've rallied back above the neckline today. Really massive reversal, going down to lows of 13,050 yesterday. So on a closing basis, if we look at this neckline here, we actually haven't really closed below that level. So the bulls are fighting very hard to prevent this head and shoulders from completing on the technical charts. So maybe it's been well watched, and maybe we are seeing some big defense of these levels from big traders and algorithms to try and stop this head and shoulders actually completing. I don't know if that's the case, but it certainly looks to be the case going by the charts today. So still looks fragile, but we are going to see some pretty massive swings, and we know historically that any sort of opportunities to buy dips in US markets generally snapped up by investors in the US. And maybe this is another case of that. S&P 500 tried to close again below this support of 4270, managed to get back above it, although we are slightly below it at the moment on the current price basis. But again, a really significant reversal posted yesterday on the daily chart for the S&P 500. So let's move on to the gun to the head trades from yesterday. I'm actually going to bring up the chart for my one, which was a CAC 40 short. I was looking to sell into a retest of this level here. So this is where I was selling yesterday. Made some decent headway lower, down to sort of 6,430 on an intraday basis. I was targeting a much lower level at 6,250, targeting almost a 4R return on that one. But come the 9 o'clock close, it was back in negative territory for me. And I think I lost 0.6R, something like that yesterday. Let's have a quick look. 0.52R. And Steve was stopped out on that exceptionally volatile gold trade, or gold day, that we saw yesterday. Had a really tight stop loss on that one. So unfortunate not to have done better on that, but there was some significant volatility around. Just looking at this now, actually, loads of charts. I'm going to sell this again, actually, and I'm going to sell it currently at 6,570, and I'm going to target a move down to the same level I was looking at yesterday, which is 6,252. So let's see how that goes today. It looks as though it's rolling over into these resistance levels this morning. So going to continue to sell what I believe is one of the weaker European indices, and hope that we get a decent payout on that by Monday. So that's my trade of the day. Just to finish up then, because I've got to rattle through a few bits because we've got a meeting at 9, but the day ahead we've got the US PCE price data, so nothing particularly high impact. On Monday, it's obviously the last trading day of the week, and we've got some pretty key events next week. We've got the US ISM Manufacturing Index, we've got the Bank of Canada policy decision on the 2nd, as well as a testimony from the Fed Chair Jerome Powell on the 2nd as well, followed by the non-farm payroll number on Friday. So plenty for us to keep us interested on the macroeconomic front next week, as well as obviously what's going on with the Russia-Ukraine situation. Obviously, there is significant risk if you are holding positions over the weekend, because anything can happen. Markets could gap in either direction over the weekend. So please do be careful if you're trading, and please bear that in mind. We'll be back next week. Steve's off on Monday, so it'll just be me, but for the rest of the week, he'll be back and we will tackle all the main ongoings in the market, as well as what's going on from a technical perspective. So until then, everybody, have a fantastic weekend and do trade safe. Goodbye.